My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour is Mr. John Mauldin himself. John, you have done a lot in your career, so I'm going to ask you a very simple question. What have you done throughout your career, and what are you doing currently?
I got into the investment publishing business from the marketing side in the very, very early 80s, like 81. I was a direct marketing, direct mail kind of guru back in my younger days for sins that I'm sure I committed in some past life. Got more into the writing about investing side in the late 80s. We started running money, at a fairly nice sized level. And then in 1999, 98, 99, started writing books. My eighth book is out now. I'll have my ninth book out next spring. 5, 6 bestsellers. Been writing my letter. Next August, I'll start my 25th year. We'll do an annual investment conference that we've done, the Strategic Investment Conference. This will be the 20th one is coming up. Time flies when you're having fun, but we've had just enormous success with it. It's one of the top investment conferences, I think, in the world right now. It really is. The speakers, the quality we get, pretty amazing. I get more amazed every year, and it just keeps getting better. Recently, I've been focusing on different ways to look at market and economic, social, geopolitical cycles. And there's a number of different writers that see the world through different lenses, I guess you could say. And we can get into this as we go through. But they all tend to point to a period of crisis sometime the latter part of this decade, early part of next decade, for various reasons. Whatever lens they're looking through says, we're going to have this crisis. They're all kind of looking at the same elephant, it's the blind man looking at the elephant thing. So they're looking at past historical data that says, look, this cycle keeps happening, whether it's a 100-year cycle, a 50-year cycle, depending on who's doing it. And they look at it for different reasons. And for me, I've been focusing a lot of my career on what I think is the accumulation of debt and the debt super cycle. And I think we're getting to a place where people start looking at it going, we may be getting just a little top heavy on the debt side, on the government debt side, especially, not just in the US, but Europe and other countries. And you couple that with a social crisis, with geopolitical crises, with generational crises, and it looks to be a fairly tumultuous time. And in your job, Michael, and mine, our day jobs, is to try to help clients get from where we are today to the other side of the crisis, because there's always the other side and you always get through it, and the world looks different. And typically, it becomes a much better, more cohesive, calmer period, and it becomes an era of prosperity and productivity. That being said, getting to it has been bumpy in the past. During the process, I've adopted 7 kids. I'm married to my wife, who has another one, and now 9 grandkids. So, and I live in Puerto Rico, enjoying. This is the best weather time of the year right now, because it's starting to get cool. That's a relative cool. It means it's in the 80s as opposed to the 90s.
Well, I will say it's also nice to have to not deal with U.S. taxes, especially when you have that many kids. So,
You still have to deal with U.S. taxes.
Right.
It depends on the source of your income and how you do it. For instance, some of my income, there's no way I can source it anywhere other than the U.S. So I pay U.S. taxes on that. The bulk of my income, because of what I do, I'm a writer, and I can do my services from here. That comes to Puerto Rico, and you pay local Puerto Rican taxes up to a point, and then it becomes 4%. Yeah, that part, which is the majority of my income, really does help make a difference. But you can't get away from U.S. taxes entirely unless you are you've already made your $100 million and you're just living on your investment income. We don't pay dividends or capital gains or I mean, we don't pay taxes on dividends, capital gains, interest, that type of thing. That's a benefit, but I'm a long way from that. I've still worked for a living. I have a day job.
All right. So since you mentioned that point about that we're at maybe a point in the cycle where the debt is getting top heavy on the government side, finally, that's starting to be, a bigger and bigger conversation. I thought the answer to that was either high persistent inflation and or higher taxes. And this is, I think, where maybe you get into the social cycle dynamic. It seems like we're also at a point where maybe society can't handle higher inflation and certainly can't handle higher taxes from where they are here. How do you think about that interaction? Because that's where I think this gets to be an interesting push and pull as far as how the future can look.
Well, I mean, first of all, we're going to run close to, the debt theoretically is 1.7 trillion, but it'll show up closer to 2 trillion because we have the off budget deficit, which for some reason it never gets talked about. I mean, and it averages 239 billion a year for the last 20 years. We'll be pushing 2 trillion this year, probably pushing 2 trillion next year. We're not doing anything to drop the debt so far. We'll see what happens in the new Congress. The new being Michael Johnson's there, and he'll have to do something, in January. But nonetheless, we're at 34 trillion, close to 34 trillion in debt. We'll be at well over 50 by the end of the decade. 10 years from now, we'll be at 60 trillion, 4% interest rates. That's 2.4 trillion. I mean, just on interest, that's more than Social Security. That's more than Medicare. I mean, the interest will start eating the country's budget. And at that point, the bond market will say, we've had about all of this pleasure we could stand. It will be the old Hemingway quote, how did you go bankrupt? Well, it was slowly and then all at once. And the bond market at some point will start backing rates up. And then we'll have a crisis. And until we have that crisis, we won't be able to compromise because there are people in Congress that would say, we're not raising taxes. Hell no, all we want to do is cut spending. And there are people in Congress that don't want to cut any spending. They want additional spending, or they don't think debt matters. And all they want to do is raise taxes. When there's a 2 trillion plus swing there, and it'll be more when you start running that kind of deficits in, 2030, it doesn't work. And so, yeah, we'll have to change that. And it's going to mean less spending, and people are not going to be happy with the cuts. And it's going to mean higher taxes. Income tax our way out of it. This isn't something we can say tax on the rich. I'll be doing this in about 2 or 3 weeks. We're going to look at, okay, what happens if you raise the income tax? Well, you could probably double the income tax on the top 10% of the company. I mean, double it. Goes from 40% to 80%. If you could actually get that, which you couldn't, you're going to knock the deficit down by, 300, 400, 500 billion. That's it. I mean, that doesn't even get us close. The only tax that will get us to a place where we're thinking about balancing the budget would be a value-added tax. It's just death to talk about it in Congress. We can do that, and that's probably what I think we'll have to do. But it's going to mean some give and take, and it's going to have to be bipartisan.
So I got to tell you that sounds like a deflationary crisis, not an ongoing secular inflationary dynamic. I've used that line a number of times myself, that debt becomes deflationary when you can't issue more of it. Now, the Fed can always buy government debt, right, and keep the game going, but there's a cost to that. So,
well, I mean, you can keep continuing to issue debt, and the central bank can buy it, but that's inflationary. But then you have that until you get the deflationary collapse. We can be Japan and kick the can down the road, but Japan is coming to the end of the road. I mean, we're now seeing 150 on the yen 10 years after I predicted it, so I'm late. and didn't make the money on that trade that I thought, which is not the first trade I've been early on. It's going to be a little bit more difficult in the late 2030s because the entire world will be going through this crisis. This isn't just going to be a U.S. crisis. Europe will probably have a crisis before we get to it. It'll make ours worse, but the dollar will get stronger, strangely, as the rest of the world has a crisis before we do. I mean, there's going to be all kinds of things that will be upside down. And if you're not trying to look around the curve rather than just looking straight line, you're going to miss it. And you'll end up making the wrong decisions. What happens is when the bond market simply says, I mean, you saw the precursor to it here a few weeks ago when they took a 30-year bond out and it ended up having to go up 6-7 bips or whatever it was. Michael can probably tell us to the mini bip, but they wanted more to take that 30-year debt. What will happen 7 years, 8 years? I don't know what the time frame will be. All of a sudden, they're going to want a lot more. It's not going to be bips. It's going to be points. That 4% 30 is now going to be a 6 or 7% 30. That short-term debt is going to be 9 or 10. You'll get a real yield curve. Well, I mean, the Fed can control the short end, but if the short end with the true yield curve, going from the lower left to the upper right if your short end is 5 or even 4, that still creates a lot of problems for the U.S. because you're constantly having to refund, and people are just going to say, well, I've got all of this pleasure I can handle, and they'll back off. And it's when the bond market jerks their chain, that's when you have a crisis. I mean, in 2008, the crisis was the debt. I mean, in the subprime crisis, I was writing about it in late 2006, and I was early, but I was right about the debt. I was wrong about the amount. I said in 2006, I bet we're going to lose $400 billion in the subprime crisis. And I had people telling me, John, you are such a pessimist. You are always doom and gloom. And, it was a few trillion. So I was an optimist. And so we had to do things differently. Now, we did some wrong things. And what I'm hoping this time, and I'll tell Twitter Spaces here, I am self-consciously writing a book through these letters. So that I started in, I guess, mid-July. As I'm going through these cycle periods, Neil Howe's generational cycle, and this fourth turning. The fourth turning is here is his book. George Friedman's written a book called The Storm Before the Calm, talking about 50-year cycles and 80-year cycles in geopolitics, which for the first time randomly occur at the same time in the latter part of this decade, which he suggests is going to create real potential geopolitical crisis, potential war, so forth. You have Peter Turkin, professor at Connecticut, who was an entomologist, a bug scientist, but he began to notice that civilizations, humans, had the same problems that bugs did. Bugs would have a population, and then all of a sudden, the population would become a crisis, and they would explode and then implode. And he noticed that as they began to look at humans, what we do, and what we've done for 1,500 years, is we overproduce elites, whether it's barons and dukes, trying to fight over land or income. You get too many third sons, if you will, second sons, who want to claim their piece of the land, and they start fighting with each other, and they drag the peasants in. Today, we've got too many elites. The tyranny of the perfect. The tyranny of experts. We now have an expert for everything. So to use a name that, Fauci was our expert. Well, it turns out that Fauci, who is an expert on what he's talking about, but he's a little bit flawed in some of his recommendations. Then you start saying, well, no, this expert says this. So you get too many experts. You get too many elites. And it creates this fracturing of society as people try to get you to line up on their side of what they think should be done. you get the global cycle that Ray Dalio talks about is financial cycles. And you've all read his, if you haven't read his books, they're worth reading. And on top of that, I don't know if I'm going to put it into my series or not, but you've got Peter Zions' book, The End of the World is Just the Beginning, where he's talking about large scale cycles, mostly built around demographics and geopolitics, because that's his world. And that's the lens that he sees things through. But it still says crisis coming. In 2008, we went into the crisis blind. So you get Hank Paulson on his knees to Nancy Pelosi saying, lady, if you don't approve this, it's all going to come apart in the next 2 days. And frankly, he was right. As it turns out, they were making it up as they went along. It seems to me nobody really thought they'd get there. And yet, when they got there, they go, oh my God, what are we going to do? There was no planning. So they had to do something. And they ended up bailing out banks. And in my opinion, if they had had a year to think about it, says this is going to happen, what should our response be? Our response should have been to wipe out shareholders for reasons that are too arcane for us to talk about. You actually have to take care of the preferreds, because it would have cost the government more to wipe out the preferreds than it would have to bail them. And subordinated bonds, you probably got to work on some of those. And then you wouldn't have removed the moral hazard like we did. The Fed was probably justified in its first QE, not, as I wrote at the time, but I said QE2 and QE3 were not necessary. They were egging things on. They were making situations worse, especially keeping things at the zero bound like they did. It completely financialized the society. It became cheaper to buy your competition than to compete. So now we have a situation where we reduce the supply into fewer and fewer sources. So you've got lots of industries where there's only 2, 3, or 4 that are actually making manufacturing, doing things. And I'm not thinking about, like, for instance, the retail industry. Amazon's such a small part. It's a big company. Walmart's a big company, but they're a small part of the overall retail space, percentage-wise. So there's plenty of competition there. I'm thinking more about railroads. There's fewer and fewer trucking companies. There's fewer and fewer shipping companies. My mind's focused on shipping stuff. But there's also fewer money managers. So many money managers are retiring. And so it's consolidating and growing. Banks are consolidating. There's fewer big banks, there's fewer public companies. And that consolidation to a free market capitalist like myself is worrisome, because I like competition. Except, of course, my competition, I wish they would go away. That's what we all think. We're the ones serving the customer, the client. The other guys aren't doing near the job we are. So
okay, I want to take it to just okay. So that's very long term. I want to take it to the much shorter term dynamic here, because you sent me a direct message saying you're starting to notice that there are some cracks at the margin around credit markets. I have obviously been wrong, or maybe just early, in terms of thinking that you'd have a corporate credit event this year. Year's not over, but obviously that hasn't played out. It's been much more obviously on the duration treasury side still. But talk about just some of the more near-term dynamics that you're seeing that you think might become bigger issues.
We're watching, I think. So I probably would have said the same thing this time last year. Often wrong, but seldom in doubt. That's just kind of me. But I think we're seeing the economy slow down, even after we've come off the third quarter, which is one of our best GDP quarters that we've had for a long time. I saw somebody today said, we're not really talking about a soft landing as so much a slow landing. So we've got a lot of debt that has to be refinanced. Something like, 1 trillion in the corporate space, 2-3 trillion in the U.S. I mean, there's a lot of debt that's got to be refinanced. You saw the really negative home builders report that came out the last 2 days. We're seeing inflation beginning to come down. It's not where it should be, and everybody thinks, well, the Fed will be able to come in and lower rates, and I'm not convinced. If they start trying to goose the economy, we'll get right back into that inflationary problem again. And I think they're going to be very cautious. A year ago, the markets were telling us we were going to get 4 rate cuts in 2024. Now it's down to 2 plus. I think by the time we get into 2024, the markets are going to be saying, well, we'll get maybe 1, maybe 2. The longer we go, those rate cuts are going to get pushed out. And it's not till we get to, 2% inflation for a while, which you can, I know that people say you could argue that it is because housing is a very lagging indicator, the way we measure it. I've written about this too much, probably my readers would say. Housing and in the indicator that you're using still showing a 5% inflation, 6% inflation when it's actually maybe negative in terms of rental, and the comps. There's reasons to think that things are going to slow down. Certainly, the home building sector is a big sector, and that's slowing down. Our energy is gone down, but the demand is going up. Worldwide, we're not producing as much. I'm very bullish on energy in the short term. I'm sorry, in the medium term. If we have a slowdown, price will go down. But I think we'll see 3-figure $100 plus, $120 plus oil, I think before the end of next year. And that will be, oh my God, inflationary, just at the wrong time. Just as people are hoping for a rate cut, we're going to see inflation, and energy coming back and spiking the numbers.
But why? What is it about next year? So I mean, the most recent, and I granted get a different time frames, right? But yeah, most recent price action's been, I think, pretty negative, and I'd argue more consistent with what you see prior to recessions. Yeah, it could be the start of some kind of a signal there.
Could be. I mean, but if you go back and you look historically, recessions always reduce demand. You reduce demand without reducing supply, prices go down. The demand always comes back. I mean, we've gone from the lower left to the upper right for 120 years now. And there's no reason to think that's going to change. So you see some bumps, some wiggles there. And those wiggles can be exciting in terms of the prices falling or the prices rising. But so that's what I'm saying. In the short term, I want to get through this slowdown. But by the time we get to third quarter, fourth quarter of next year, we'll be through whatever it is that we're going to be going through. Demand will pick back up globally. Energy prices will come back. I mean, we're going to see. I haven't seen the price action today. I'm nowhere near a screen, but I would expect that 2 things happen. Number one, China, Xi meeting with, or Xi rather, meeting with Biden was useful, in terms of kind of calming things down. But the more important thing was the 2 opposition parties in Taiwan agreeing to work together. Now, they haven't said how they're going to do that yet, but they're going to agree on a candidate, probably some power sharing arrangement. The 2 of them together should be able to put, I don't want to call it a pro-China, but it won't be an anti-China party in, which is what's currently there, what's making the Chinese so nervous. You put the KMT or the People's Party back, or however they're going to share that, it may not look like 2006, 2008, when there was a lot of cooperation, but it won't be the tinderbox, and there won't be the immediate need. That's what the hope is, for China to go in and think that they need to physically take Taiwan. China's been perfectly willing to play the long game as long as they don't see it running away from them. Frankly, the Chinese economy is not doing well for mostly free market reasons. I mean, Xi thinks he can run a top-down economy. Top-down economies just don't tend to do very well. They're not going to grow. I mean, you can survive. China needs 5-6% growth. They're getting ready to grow. China's getting ready to go old before it grows rich. What Xi has basically said, the Communist Party's basically said to entrepreneurs, you can get so big, but you can't get too big. your business has to be run for the benefit of the Communist Party, and you get to a certain size, and then all of a sudden you've got a party member that's on your board looking over your shoulder. They're going after taxes from different various groups. It doesn't foster a let's go out and create a new business, start something. You don't have that Silicon Valley mentality, or that Austin mentality. To answer your question, not surprised at all by Xi coming here. The surprise part was the two opposition parties who really haven't cooperated in the past, coming together to cooperate. I think they realize that this is kind of a watershed moment, and they're looking at each other and going, okay, I was talking about it. We need a crisis in order for the U.S. Politicians to cooperate. Well, I think the opposition parties in Taiwan looked around and go, okay, we're going to have a crisis if we don't have cooperate. And so they're in crisis avoidance mode. So those things can be useful.
So John, the last 2 years, the irony was that the best inflation hedge was the dollar, right, relative to everything else. If you're right about oil next year surging back, and then the argument of another wave of inflation, what becomes the inflation hedge to play that? Because I don't know if it would be the dollar in the same way again.
Well, if you're a dollar investor, I'm not, not an investor. If you and I live in a world of dollars, and our inflation, the dollar hasn't been a hedge for me. I mean, I put it in my letter last week. Somebody creating some charts on Twitter, which I thought was kind of fun. But I talked about my prime rib. I'm an amateur cook, but I make, in my own personal estimation and the estimation of people who have tasted it, I make the best prime rib in the world. I mean, it's really, really good. And I put my recipe in my letter last week. I put a link to it. But in doing that, I went back to the first time I published my recipe, and it was like 2013, something like that. And the cost of a prime back then was roughly, to buy at Costco, was roughly $10 a pound. Today, that same prime is $18.75 a pound. And so it's 87% in the last, 7 or 8 years. I feel that inflation. When I go, I'll go buy a 10 or 11 pound prime, because we'll have 40 people coming to Thanksgiving dinner in Dallas here in a couple of weeks, or next week. God, what's happening to the time? And that 11 pound prime is going to be $300 to walk out. Out the door with.
So what you think is that prime rib is a good hedge to inflation?
Well, I don't know that a dollar. I don't know that there is a hedge in a dollar world. If you're in Europe, or you're in a third, another country, dollar might be a good hedge for you. But I don't know that we don't have that luxury of saying, and because gold hasn't been much of an inflation hedge.
Yeah, and I guess that's kind of where I was going. It's it's like what would be where the momentum transfers to most likely in the next inflationary cycle, right? And under that scenario, would not be treasuries. I don't think it would be tips, because there's enough skepticism around CPI,
right,
use, right? So it seems like there's not that many options other than gold or maybe Bitcoin. Bitcoin certainly was not an inflation hedge the last cycle, but maybe it would be the next one.
I'm not certain what Bitcoin is, but I don't know that you could call it an inflation hedge. You can call it something, but I don't know that it's an inflation hedge.
From a like asset allocation perspective, I'm curious for you. Obviously you got your income on your publishing business and other sources of other businesses, but I'm curious, where does John Mauldin put his incremental new dollar to work in?
I've got a lot of my money in very specific biotech stocks that I happen to like. That's kind of where and then the rest of it, the bulk of it, is in, large multi-asset, multi-strategy hedge funds. If you're an accredited investor, there's platforms you could get access to that are available. So I've got a lot of that. Dividend, just plain old dividend growth stocks, not dividend growth, dividend, high and, dividend companies, large companies that have raised their dividends every year for the last 20, 30, 40 years. I mean, if you compound dividend growth of 5 or 6% a year, yeah, your value is going to go up and down, but that dividend makes up when you can get a 4%, yield on a portfolio. That makes up for a lot of sins over time. And then the rest of it just is all various alternatives.
Yeah, it's been a hard year for dividends, but I happen to think that, like you, the pendulum swings from capital appreciation growth, to more value dividends, and now yields are obviously a lot higher across the board. So I think that makes a lot of sense, but it's also not exactly a very sexy thing for most of media, right? You never hear people talking about creating, blue chip dividend name. Well, it's just an observation about cycles, right? That the pendulum will eventually swing from the Magnificent Seven, capital appreciation growth type of names back to dividends, especially if you're closer to the end of the rate hike cycle, than
right. And dividends will be, all of these things work in cycles, but then that's kind of how it works. So,
is there anything that you're focusing on that maybe are under people's radars that people are not paying attention to that you think will be a bigger deal going forward?
I don't think people understand the ramifications of the biotechnology improvements that we're seeing. I'll be writing about it. I'm not going to mention the company yet because it's still I happen to know there's a study that will be posted here in about 4 to 6 weeks, should be. But it's going to be one of the most explosive anti-aging stories that we've seen in the last 20 years. I mean, it's staggering. It's just the beginning. People don't understand when you really are going to be able. This drug, by the way, will be the fountain of middle age. It's not the fountain of youth, but it is going to slow down or actually turn you back to middle age, which to me, I'm 74 right now. Middle age sounds pretty good. So I'm looking forward to being able to get access to it. I can just say that within 4 or 5 years, you will be able to get this through unconventional means. And you will. Because everybody, when people see what it does, they're going to want it. And there are competitors coming along right alongside that are having different results, things. That's so under everybody's radar right now. They don't understand. When you can add 10, 15, 20 years or more of a productive life, I'm not talking about, just getting older and older and feeble. I'm saying you've got a productive, you're on top of your game life. That's a major change. And it's going to have all sorts of positive ramifications. It will, and I'll be writing about this tomorrow, it will make the Social Security problem worse. It will actually make Medicare better. Because one of the things these drugs, these compounds are doing is it's reducing inflammation. It's reducing some of the wear and tear on the body. It's reducing the things that kill us. You spend half your money in the last year of your life in terms of our health budgets. When you start postponing that last year of your life out 10, 15 years, it's going to reduce our health budgets, our Medicare budgets. That's a good thing, but it's going to as people live longer, they're going to be getting their Social Security more. I mean, I remember the 80s thinking and writing that we wouldn't get I wouldn't live long enough to get I would never get Social Security when I got to retirement age. Not only am I getting Social Security, I'm getting $50,000 a year, which is, it's a number that's for me, I can see that in my bottom right-hand corner. Now they make me pay taxes on it. I mean, we were talking about taxes. That's a U.S. tax that I cannot avoid. So and I'm still paying Social Security taxes. So it's not as much of a benefit as one might think. But that being said, it's living longer is the one thing that I really think people don't understand. And I'm hoping the first guy that turns 150 is going to be 74. And maybe it'll be somebody that's in better shape than I am, and they're 80 and they get early access to this stuff. There's some really good things. So that's my John Mauldin dream, I guess.
Yeah, that's definitely exciting on that end. John, for those that want to track more of your thoughts and be among the million that read your stuff, where would you point them to?
My newsletter is called Thoughts from the Frontline. You can get it at Mauldin Economics.
I'm a big fan of John's work. I'll have this, again, folks, as an edited podcast. Please make sure you follow John Mauldin here on X. Check out his research as well. And hopefully I'll see you all a little bit later doing a live show with video with Mr. Dan Niles at 5 Eastern. You'll see that here on X. Thank you, John. Really always a pleasure to talk to you.